want to be materialistic, but yes, the truth is that we just cannot avoid being a part of the consumption cycle. So it's better to understand all these in more details. So that is what the ongoing session is going to be about, and how do we utilize and understand the consumption pattern to make money, as we all also, I mean, whatever our friends are consuming, what our colleagues are doing. So this is all going to influence our decision making when we go out and make some purchases. So we would like to be a part of this journey to inform and, make it interesting, and everyone understand the way things work in the economy, and how do we benefit out of it, how do we make money out of it. So let's begin today. So to begin the session, I would like to introduce Ms. Nehal Mota from Finovate. She is the co-founder and director at Finovate, which is a SEBI registered investment advisory firm, was listed amongst the 40 women entrepreneurs by Goldman Sachs. She is a postgraduate in management and MDB from IIM Indore. I can vouch for her passion for creating financial awareness in the society, and that's what has led her to have a rich experience of 2 decades in the field, and also conduct more than 500 educative workshops and webinars, and as she has trained over 25,000 people to successfully manage and grow their finances. So over to you, Nehal, to initiate the session. Good morning.
Good morning, Rekha. Good morning to all the panelists, and good morning to the audience. They are the ones who encourage us to keep coming up with different subjects in personal finance. So I won't take too much of time for the introduction. I think everyone knows what we do at Finovate. We basically focus on financial life planning, which is, marrying your finances with your life goals, life situations. And we have like 6 pillars of personal finance. We have to understand what income, expenses you have as a family. First step is take the risk out by planning proper insurance, whether it is professional indemnity, health, term insurance. Loan management. Our goal with families is to get them debt free as soon as possible. Then after that, plan for the key goals. If you make random investments without actually understanding why are you investing, what is the end goal, then you end up taking decisions where the asset allocation is not in sync with your life goals. The most important thing is the money saved is as good as money earned. So we focus a lot on taxation. And in taxation, it's not about not paying taxes. It's about planning the taxes wisely. So you can have your HUF. A lot of doctors are practicing in sole proprietary setups where they are actually paying 35% tax, whereas a private limited company can actually bring their taxation down by 25 to 25%, which is a wise way. And you are also, getting your earnings in a private limited company. In future, if you have to, hand over your practice to any big firm, you get a P multiple of the EPS or, the earnings of that particular private limited company. So it's very wise to actually have a private limited company. And last but not the least, succession planning. Eventually, all this exercise of personal finance is for us to give the wealth to people whom we intend. So what we do at Finovate is that we tie up all the 6 aspects to actually help you save your time when managing your finances, and also ensure that your family goes to the life goals in any and every situation. So moving on, Pranav, can we go to the next slide? So I've spent 2 decades in the markets myself and have worked with a lot of promoters who went on, from a 50-100 crore to now 40-50,000 crore companies, and spoken to many big people in the market, many fund managers, many big investors. Eventually, what I've understood, it only boils down to a very simple formula, which we at Finovate have a framework. We call it the ARC formula. So the only way to create wealth in the long run, or actually get a very well-balanced financial life, is getting your asset allocation right. If you are investing in equity, but out of the cash flows or the money which you earn, you're putting in very small amount of money in equity. And if it doubles, triples, becomes 4 times. But overall, if I look at your asset allocation, you're 90% in real estate and only 5 or 10% in equity. Does it mean, or does it add any value to your life? it really does not add that much value. So getting your asset allocation right, understanding that how much are you in equity, gold, real estate, and fixed income, and how much in cash, and then with your life goals, matching the investments which you do. So getting your asset allocation right. The second thing is regular investments. This is one place where my study of 2 decades of seeing people coming to equity market and then not making the kind of return which the market has generated and being unhappy about it. Why? Because in 2007, they've seen a 5-year or a 4-year bull run. They come with a lump sum amount in the market, and 2008 subprime happens and the portfolio becomes 1/5 or 1/4, and they feel market is bad, everything is bad. So a lump sum or a one-time investment in market does not work. We earn money every year, and out of that we put money in all the 4 asset classes. So equity is all about regular investment, and forget equity, I will say every asset class, it's about a regular investment. And you need to ensure that you invest regularly in all asset classes. And last but not the least, I have said this in all my presentations, only work what works for long-term wealth creation is the power of compounding. You making that investment, you getting your asset allocation right, and you staying invested for a long period of time. So in this, I'll just take an example, the rule of 72. If you have any asset class, say for example equity, and Indian equity markets has compounded at the rate 15% in the last 20-30 years. 72 divided by the rate of return is a number of years in which your money doubles. So I've given an example that if you started with 1 lakh rupees in equity market, if it's compounding at 15%, 1 lakh becomes 2 lakh in 5 years, 2 lakhs become 4 lakhs in 10 years, 4 becomes 8 in 15 years, and 8 becomes 16, 20 years. So just keep it, you started with 1 lakh in year 1. And that 1 lakh which was in year 1, by the year 20th, it is 16 times. Okay, you have to stay invested to make it 16 times. And just see this, how power of compounding works. In the year 15, 1 is 8, but in the year 28 is 16. There's such an exponential jump in compounding which happens between 15 to 20, 20 to 25, and 25 to 30 years. And so we say you need to start early and you need to stay invested. Your year one investment will become 16 times in year 20 if you just stay invested. You're not foolish. You're not chasing multi-baggers, or you're not chasing some phenomenal returns. Only a 15% CAGR will give you 16 times your capital in year 20. Year 2, again, you invest 1 lakh. In year 21, it again becomes 16 times. Year 3, so that is how you start getting into this knack of wealth creation. Okay, and that is what we say the ARC formula: asset allocation, regular investment, and power of compounding. If we can just go back to the previous slide, Pranav. People say that do we need to be some great investors to understand how to create wealth? So I'll just demonstrate with 1 or 2 examples. Here we've taken that if someone had invested 1 lakh in 1979 in a fixed deposit, the CAGR since 1979 to today is 8%. So the 1 lakh would have been 27 lakhs. If the same 1 lakh rupees was put in gold, that time 1 tola price was 937. Today, 1 tola is 50,000. So 9.7 is the CAGR return. So 1 lakh is 53 lakh. The same 1 lakh rupees, if someone would have invested in a property, I've taken an example of Worli, which is a prime location in Mumbai. That time per square feet rate was 700. Today per square feet carpet is 1,25,000. And the CAGR return is 12.82. So 1 lakh would have been 1.78 crores. And the same person would have just started a regular investment in Sensex. The unit, it started at 100. Today, the Sensex is 53,000. I think this was a presentation month back. It has even gone further up. The CAGR is 15.74. The 1 lakh in Sensex today would have been 5 crore 34 lakh. Now, people will say that 12.82 and 15.74, it's not a huge difference. It's only a 3%, but 3% on compounding the end fund value, where 1.78 crore and where 5.34. There's such a big difference, in the long run when you invest in the right asset class. And, I'll just demonstrate that why equity and what people make mistake when they come to equity. So here I've taken a real example of a mutual fund investor. In the year 2001, the gentleman started with 3 mutual funds, 2,000, 2,000, 2,000, just 72,000 a year. And this person did not talk to experts like us, did not watch television, was not too worried about the news which is coming in or the noise. He just cut out all the noise and he continued a systematic investment. The regular investment which I was talking about came 2007. This gentleman had invested only 5 lakh. Above the pink bar, if you can see 5 lakh, there was a bull run in 2007. His 5 lakh rupees became 34 lakh rupees. Now, at that point of time, he would be tempted to come out of the market. There would be some news that the P multiple of the market is too high and I should exit the market. But this person didn't believe in timing the market, didn't believe in, he was investing for a goal which was 20 years or 25 years away. He didn't do anything when subprime crisis happened. Came 2008, his 34 lakh investment became half. It was 17 lakhs. Okay, lot of people panicked and they said 17 lakh mil raha hai, take it out of the market and let's go out of the market. Because that was the recent bias which people went through in 2008 and they thought that this is the end of the world, it is end of everything. Sensex of 21,000 was down to 7,000. And people thought abhi 5,000 ho jayega. At 7 and 9,000 people talking about 5,000, or probably that was a perception ki market won't exist. Everything is like gone. This person, even in 2008, he put a 72,000. 2009, he continued to put 17,000. Just a year, 2008, his portfolio was 17 and 2009, it became 35. It doubled because he was patient in that bad time. And then if you see from 2009, when his portfolio became 35 to 2013, he got no return. 35 became 45. So in that phase, I spoke to a lot of investors and they said, please, stock market investment hai, so don't talk to us. We don't want to talk anything related to stock market. We've seen SIPs. SIPs also don't give any return. And they are right. Equity is not linear. Okay, it is non-linear. You may have 4 or 5 years of zero returns, and you can have 1 year where market can give you 100% return. Same happened in 2017. Mr. Narendra Modi won the election and market made a new high. And so his 45 lakh portfolio directly jumped to 71. He still continued through all the good news, bad news, your demonetization happened. In 13-14, the banking crisis happened. In 2010, the COVID happened. Now today, in 2021 end, if this gentleman has to look at his portfolio, he has invested 15 lakh rupees via SIPs in mutual fund or else a regular investment. Today, the fund value is 1.81 crores. He is sitting on a compounding return of 21%. Market is given 15% compounding, but because he has been buying on ups and downs both, his CAGR return is much higher. If the same gentleman would have continued at an 8% FD, his investment of 15 lakh would have been 39 lakh versus his investment of 15 lakh is 1.8 crore in markets today. So I would want to end my part by telling you that the only funder of creating wealth in the long run is the ARC formula: asset allocation, regular investment, and power of compounding. Okay, here we spoke about regular. Now I have a very fantastic team with us to talk about that. What from now on? Okay, now we are at say X amount of Sensex levels. From here on, what to expect? Do you think this kind of a growth will continue in the market? And if in case you want to directly invest in companies, which kind of companies should you invest in? How should you, look at them? Should you be actually buying and selling, or should you hold them for the long run? So all over to you, Rekha, for the main part of today's event, talking about the consumption cycle and the B2C companies.
Thank you, Nehal. I would like, if I may conclude whatever you spoke about. So the conclusion is that equity can be looked upon as one of the best form of investment. And I would say discipline and patience is the key for creating a wealth over a number of years. Yeah. So thank you so much for that insight. And now coming to begin the main session for the day, two speakers from Alder Capital. I would like to welcome them both, Mr. Hemant Patel and Ms. Rakhi Prasad. Welcome both of you to a very good Sunday morning. Just a brief introduction about Hemant. Hemant has good 20 years of experience behind him in institutional equity research. He is the managing partner with Alder Capital. He has been voted by Wall Street Journal as India's top analyst for home and personal care sector, and has received 2 consecutive awards from Reuters StarMine for consumer staples category. Welcome, Hemant. Good morning to you. And the next speaker for the day, Rakhi Prasad. She is an investment manager with Alder Capital. She has expertise in investment research, covering financials, healthcare, and technology. She has over 20 years of experience across asset management, investment banking, private equity, and risk management. Rakhi has also been honored as India's top 100 women in finance in 2020 by AIWMI. So we welcome both of you all.
Hi, Ravi.
Over to you, Mr. Hemant and Rakhi.
Hi, Rekha. Hi, Nehal. Welcome you all the guests on here this morning for a discussion on the consumption sector. And thank you for the kind words. A quick addition to what Rekha had mentioned. Been working with some of the finest bright minds in the country when I was a young analyst for the last 15 years. It's a journey that we have had. It's been 22 years since I've been in the capital markets, and the journey has been extremely fulfilling. In the last 7 years, I've had a wonderful team with us, Rakhi, Sunita, who also have an impeccable background from the financial industry. And without further ado, let me start getting into where we are going to be discussing on the consumption sector. I'll just put up a slide out here. Hope all of you can see this. Yeah, so as Rekha and Nehal have said, we specialize in a particular area, which is B2C consumption. A large part of our careers have been advising institutional investors globally, domestically, in this particular space. It's a very large space, and it's our pleasure to actually talk to you about this. We at Alder Capital have been seeing and investing into this in the last 7 years through the fund that we have. Getting into the first part of it, what does the Indian market hold for consumption, right? And we need to step back a little bit to understand consumption first before we start looking at the layers below it. A quick update on this, well, the Indian market is powered by consumption, 60% of our GDP, right? And you can see this chart out here in 2022, it was 1.8 trillion. Mind you, this has been driven by obviously the 1.4 billion population, but you can see over the last 10 years, consumption has tripled, right? I mean, think about it. In the last 10 years, like Nehal just mentioned in our call, that we have gone through various cycles of change brought in by the NDA. We have had DeMon, we have had GST implementations, we have had our own credit crisis. We have had a time when the banking system was in stress, right? Despite that, consumption has gone up by 3 times. What do we think is going to happen in the next 10 years? Well, we think that it's still going to expand by another 3 times. It's going to become $6 trillion of a $9 trillion economy. And what does it mean? It means that while India is the 6th largest economy in the world, eventually in 10 odd years, we will become the 3rd largest consumption economy in the world, just after US and China. And that's the reason why we are super excited. We were excited about consumption 10 and 20 years back. We are still extremely excited about this space as we go along. And why is this really happening? Well, just put it very simply, the income effect, as we call it as, that 1 in every 4 households which earn an income of around 8 lakhs rupees per annum and above, that is going to become 1 in every 2 households in the next 10 years. What effectively it means is the large percentage of our population is going to have mid to high income earning capability. And what they will do with that is obviously invest into various aspects of consumption, which could be products and services. Now, if you look at the Indian market, right, we are 3.4 trillion, and consumption, this yellow bucket out here, is roughly around 38%. Now, one might even ask us saying, hey, Hemant, consumption is 38%, but why is it that, on a GDP, it is 60%? So there's obviously a gap, right? There's a gap between market cap and in terms of GDP. And we believe that over a period of time, as many businesses get introduced into consumption space in the listed universe and current existing businesses continue to grow and expand, this gap will get bridged. We probably will have at least 45 to 50% of our market capitalization as consumption as we go along. Now, Another thing I want to point out is a lot of people construe consumption as only staples. What do I mean by that? It means that people think that consumption is all about Lever and Nestle and P&Gs of the world. But that's not true, right? Consumption is a larger basket. As mentioned by Rekha, that when you look at consumption, there's products and services. When we say services, it could be anything. It could be retail, it could be healthcare services, it could be financial services, which is consumer lending. And on the products, it could be a vast range of products, right? It could be discretionary products, it could be cars, it could be homes, it could be consumer staples also, apparels, jewelry, and the likes. So it's a very wide space. And we believe that this space is likely to do extremely well as we see the income effect play out. Now, while we speak very loud about consumption, I want to take 4 sectors and I talk about it a little bit more deeply because to give you some flavor as to what we really think is going to happen over the next few years and how we see that space. And I'm not going to get too deep in this to keep it a little bit at a higher level so that you get a grasp of it. Let's take retail, for instance. Retail is one of the largest sectors that we have in India, right? It's $700 billion. Retail in India is as large as what it is in UK. Retail has been actually growing in India at around 10% per annum, right? But within this $700 billion, you have a share of modern retail, which is like your D-Marts of the world or your Geo Malls of the world. That space is roughly around 10% of this $700 billion. So you can imagine that the organized space of retail is just 10% of the overall retail market, right? And that space has actually been growing at 20% per annum, which is twice the growth rate of the overall retail sector. And the more interesting part out here is when you look at the organized space, right? The top 5 players command only 5 to 7% of the total retail market. So you can imagine how fragmented this industry is, unlike other markets in the world where the top 5 players have 30 to 40% market share, right? So in our view, the potential of retail is enormous. Online platform is currently around 5%. So modern trade and online put together, which is 15%, is likely to become maybe around 50 to 60% as we go along over a long period of time, right? And that's the potential for growth. So when the CEO of Avenue comes out and says that, hey, we got 280 stores in India today, and we can scale this up to 1,500 over the next 10 odd years, right? We do believe it because the potential is immense. I mean, we were on a call with him and recently he said that, you know, everyone's worries about competition, penetration levels, but imagine that we have around 60 to 70 odd stores in the city of Mumbai, and we believe that we can double that, right, without having any problems. So imagine that retail is well beyond, in terms of scale, it can really go up. Another sector is healthcare. And all of you on this forum are doctors. I'm very happy to actually have a discussion on this as well. But, you know, this is the contradiction in healthcare. When we say we are the 6th largest economy in the world, right, we rank 146 out of 181 countries in terms of our healthcare spending. Now, this is dismal by any standards, right? So when we look at the space, what's the problem? I mean, affordability is a big issue in India. When you look at healthcare spends, think about it, the Indian pharmaceutical markets, which is branded generics, is actually there predominantly in the top 10 cities. 60% of the pharmaceutical product sales happens only in the top 10 cities. So what happens to the other part of India? Rural accounts for only 20%, right? And this is a big disconnect between where we think when income levels go up, obviously it means that households across strata will be able to consume, right? And a large part of this growth, unfortunately, also should happen with government-sponsored schemes. Globally, think about it, that when you look at countries like US and other developed economies, the number which is put out is that 70% of a household spend is being taken on healthcare is being taken by the government, right? In India, it's the exact opposite, right? The households who have low income or mid income literally spend 70 to 80% on their own. So they do not get supported by any schemes for the government. Obviously, they have less insurance coverage, and that's a problem. So in large respect, we believe that over a longer period of time, this is yet to play out, right, in a significant way. And we could see a J-curve out here as well as we go along. The other space that we are very keen on also is diagnostics. And then again, the diagnostic story is similar to the pharma story, where top 10 cities constitute 42% of revenue, right? And you won't believe it, that the top 4 players in India are just 9% of the market. Large part of the market is run by standalone centers, right? And these standalone centers, mind you, obviously do not have the level of benchmarking that a regulator would require. And obviously the regulatory environment in diagnostic also is relatively poor. So in a larger sense, we believe that COVID was a kickstart. It was an awareness which every household realized that there is a need to get ourselves diagnosed every 6 months or every year for our own betterment, right? And that Y2K movement happened during COVID. So in a larger sense, we really like this space. We have investments here, and we would love to see through this over a long period of time. Another controversial subject, consumer tech. When I put this up, a lot of people have many questions, and we go into hours of conversation to get them educated on this. But let me put it this way: let's break it down into a very simple manner, right? Why are we keen on consumer tech businesses, despite the massacre which globally they have gone through, right? In the US, in China, and in India, for some of the names which are listed. Now, go back to the fundamentals. Let's look at the 3 things that have changed. Why consumer tech businesses do well. One is accessibility, right? Because Reliance crashed the cost for data, right? At one point, data cost was around 150 rupees per gigabyte, right? After Jio came in, the data cost crashed to around 11 rupees per gigabyte. Effectively, what it did was people started consuming from just 1 gigabyte a month to around 13 gigabytes a month. Now, that accessibility of reducing the cost has resulted in roughly 670 odd millions coming onto the internet, right? And it's exploded. 290 million people actually buy goods and services on the internet. Now, this is huge by any standards, right? You can imagine that the reach which some of these platform businesses have generated because of pure accessibility is immense, right? The second thing is convenience, right? Many of these consumer tech businesses provide convenience in terms of cost, whether it is turnaround time. Cost would be it would be time. It saves you time as well, like deliveries. It could be turnaround time for getting a loan, and convenience in terms of transactions, right? So a lot of convenience has brought in all these customers. And the third thing that is driving adoption is trust. As you start using these platforms regularly, it becomes a habit formation, right? Today, if one were to tell you that, there's not going to be any Zomato or Swiggy, imagine what would it do, right? Today, if someone did tell you that there's no payment platforms, imagine what that would do. So what is happening is that generation or that shift is creating a huge amount of unit economics change for many of these businesses. And why I've tried to show you this slide on the bottom out here is that this is our own projection of how we see these businesses turning profitable over a period of time. Now, a lot of people do believe that, Paytm and Zomatos of the world will never show profits, right? Many of these businesses have actually gone out and said that by mid next year, we will actually break even and we will actually start showing profits at the bottom line by the end of next year, right? We also believe that the unit economics are working in this manner. And we like platform businesses largely because they're very different from typical traditional consumer businesses. Many consumer businesses, you need to set up infrastructure, manpower, manufacturing plants, distribution. It takes time to scale, right? You can imagine what happens when that is not required. Just look at the top right-hand chart out here. State Bank of India, since 1955, it brought in 468 million customers, right? HDFC Bank got in 71 million customers after being established in 1994. Paytm, on the other front, 2010, and within 12 years, it has got 71 million customers. And mind you, this 71 million customers is for Paytm Bank. Paytm by itself has 350 million customers as on date, right? So in a large way, we believe that as users come onto this platform and as unit economics are turning, this will become highly profitable and eventually create a huge amount of value. BFSI, which is banking, financial services, and insurance. And I'm going to talk about consumer lending out here because that's a focus area that we have. Banks has been traditionally a sector which has been there historically for a very long time, but they have had their own cycles, right? If you look at the banking cycle, a large part of the problems emanated during phase of 2015 to 2018, right? Because of prolonged forbearance, a lot of private and public infrastructure projects went stale. Corporate governance issues in some commercial banks, right? And the commodity commodity price crash. And because of that, the asset quality of the banks rose to its highest level seen in 2 decades, right? It had gone up all the way to around 11%. Since then, the banking cycle has slent up. Lending growth rates crashed, right? Apparently, since then, banks have been very cautious. And in a large way, NPAs have come down to 5.9% and still declining. What we really like is at this stage is not only banks, NPAs have declined, capacity utilization in the economy has gone up, right? Which effectively points out to the fact that banks will have to lend more at this stage, and corporates are going to borrow more to set up greenfield and brownfield plants, right? And we are seeing the banking credit cycle pick up. But moving on to retail, what we really like about retail is retail lending is roughly around half of the banking sector credit. So let's say the banking sector credit as on date is 150 lakh crores, right? Retail lending is roughly around 49%. What's changed in retail lending? Well, the biggest transformational change that has happened in retail lending in the last few years is small ticket size loans. I mean, I don't know whether all of you do know, there's something called as payday loans, there's virtual digit credit cards. These are things which have evolved in the last few years, which is making access to credit even to people who could never access that kind of wallet in the past. Now we are getting to see banks, NBFCs, and fintech platforms catering to this part of the need, right? And that's one of the big reasons why you're having lending actually pick up on the retail side. So retail lending is something that we are extremely bullish on. And we do believe that over a period of time, it probably can even grow at 20-25% per annum because the penetration levels are really low. And the another thing that I would point out is bounce rates, right? A lot of things that people really talk about is bounce rates, is because when you give a check to a bank and by chance it gets defaulted or it doesn't get credited, we call it as a bounce rate, right? As bounce rates point out to a lower number, which is 22%, it is actually reaches pre-COVID levels, even better than pre-COVID levels, right? It basically reflects that the economy is on its mend and consumers are spending and moving ahead, right? So banking is one space that we like. Consumer lending over here we like. We like many businesses which both banks and NBFCs which lend in this space. Now, it's a little bit of a dense slide in terms of numbers, but I'll try to break it down for you. The big question that Nehal and our team had asked is, hey, where are we in the consumption cycle, right? It's nice to see all these long-term stories about consumption, but are we at a high point? Are we at a low point? So what we try to do is we try to triangulate this in terms of numbers for you. And we said that let's look at consumption cycle from the last 13 years and break it down for you into 3 parts, right? The first part, we call it as the expansionary phase. This is immediately after the global financial crisis. The next part, we call it as the moderation phase, which is 2014 to 19. And this is the phase when the NDA government came in and made multiple reforms that slowed down the economy in a large sense, right? And then the last phase, which we call it the trough phase. And this is the phase when we had the pandemic. Now, notice this, that in the expansionary phase, inflation was at 10%, yet the economy grew at 7%. And if you look down out here, right, the entire consumption B2C space, the earnings growth was around 26% and the revenue growth was 17%. So apparently, this universe of over 230 odd companies that we have analyzed to get you this data, right, it did very well during the expansionary phase. In the moderation phase, which is the next phase, you notice that inflation dropped, right? But banking credit growth also slowed down. NPA cycles rose to around 8%. What did it do? It slowed down the entire B2C space, right? Because if you remember, those were the times when the NDA government was making multiple changes, whether it was DMON or whether it was GST, right? What did it do to the earnings growth and revenue growth of the business? Well, it slowed down again. 12% to 12%. I mean, this is the revenue and earnings growth CAGR during that phase. And then finally, when we all thought that there will be some amount of recovery after this, nobody could predict this, but we got into the pandemic phase, right? Look at what has happened to the GDP growth rate in our country. And I'm giving you this number because this is far more important number than the number which has been put out by the government. When the government of India says that we have grown by around 7%, it is coming on a degrowth, right? So it's very critical to see growth in their economy on a CAGR basis. And you notice that it's only 1.7%, effectively meaning the economy has just about got to its pre-COVID levels, right? And then you notice that the credit growth has still slowed. NPAs have coming down, but it's not giving you any indication that there is any favorable tailwind. And the worst part of it is consumer sentiments during this pandemic phase. It dropped over the lowest that we had ever seen. What does it mean? It means that many discretionary categories where we thought demand will do well did not do well. People held back, saved, did not want to spend. And effectively, what did it lead to? Well, if you notice this, the B2C space, you notice there's a 3% revenue growth and a 5% earnings growth. So effectively, what we are trying to tell you is, against this, look at what has happened in Nifty. Nifty managed to give you an 8% revenue growth and 24% earnings growth. So consumption, in a larger sense, has gone through its worst phase. In fact, we've been saying this now very openly to most of our investors, saying that, you're at the bottom of the cycle. You couldn't get any worse than this. There are many businesses which shut shop, both in financial year 21 and even in 22, both the first wave and the second wave. Business results have been terrible. Now, if you see the performance of many of these businesses in the last quarter, it's remarkable. Many of these businesses have generated profits in one single quarter equivalent to what they generated in the last year, right? And that's one of the reasons why we're saying that this is something that one should really look at from a longer term, because you're really at the bottom of the cycle. Now, another dense slide, bear with me. We are analysts, unfortunately, we keep throwing these kind of slides out. But it's my duty to try making you understand this as well in a simple manner. But let's look at it this way. Many investors ask us this question that, hey, is consumption related to the economic cycle? Yes, the answer is yes, right? The relativity differs. Some sectors like consumer staples, home care, personal care, right? Food products, medicines, they are not geared to the economy. Basically, when the economic cycle goes down or up, these businesses continue to thrive. There are other sets of businesses which are basically into small appliances. It could be clothing, it could be footwear. Yes, they are geared to a certain extent with the economy. And then the third type of consumer businesses, right? Those are large consumer durables, like we're talking about white goods, cars, homes. These are things which basically have a high gearing to the economy, right? So when an economy moves up and down, it's very important to understand that businesses also have volatility. So what we have tried to do for you over here, we said that if you analyze these 230 odd companies over the last 10 odd years, you will get a matrix which shows you revenue growth of these businesses, how sustainably and how well these businesses have done over a long period of time versus volatility it generates. And I've shown you Nifty 500 out here, right? Now, Nifty 500, in our opinion, is in the worst quadrant. Basically, it has lower revenue growth and has got equivalently high volatility as well. I mean, you don't want to own a business which is giving you lower growth and also equally volatile, right? What you want is basically to be in quadrant A and B, which basically means that you want businesses which are growing faster, but least amount of impact, economic impact or business impact, whatever in both the cases. The same thing that you want business also in quadrant B, where we want businesses which are growing very fast. And yes, they could be a little volatile, but the growth takes care of the long-term returns that investors have. And that's one of the reasons why we say that do also focus out here if you're a long-term investor. Like Nehal said, right? If you are looking at power of compounding, you can't ignore quadrant B because it will get you there. It will get you over that 15% hurdle rate that you have in your mind. And then finally, speaking to you on the last thing that I want to touch upon the slide is, people very often forget that the markets, why are many sectors growing in these markets is because of two reasons in a large sense. India is a country of have-nots, right? A lot of sectors don't have penetration levels at all. Look at air conditioners. Only 24% of the households have air conditioners in India, right? Long way to go. Cars, it's only 8% of the households. So it's a very long runway, right? Retail, one might say, hey, retail is already 95% penetrated, Hemant, so where will it go? But what you've got to look at alongside with this is the fact that only 11% is organized, right? So when you're looking at a sector, you have to combine both these in terms of penetration and organized share to understand the potential of a business. And that's what we need to look at from a longer term basis. So that's one of the reasons why we like consumer finance. Just look at this, 29% penetration levels and organized is 54%. And this is still expanding in a huge way, right? So this is the reason why we say that we need to be spread out across consumption sectors and need to be focused in quadrant A and B from a longer term perspective. Now, while we speak very highly of revenues, it's important to look at earnings. Again, we posted this 230 companies analysis over the last, and I'm clearly taking pre-pandemic because the game was completely different during pandemic. Everything actually collapsed, right? But pre-pandemic gives you a good picture in terms of what happens in a normal cycle. And you'll notice, and there are two things that one has to understand, is that revenue growth does not have one-on-one correlation with earnings growth of businesses, right? As simple as that. At the same time, earnings growth of a business is driven by 4 or 5 factors which are different, right? They will be driven because of pricing power. They will be driven because of operating leverage, financial leverage, right? And they will be driven by other factors, internal driven factors, right? So the point here is that what we have tried to showcase is that you look at these businesses, there are few interesting observations that comes out from earnings growth. You notice the top 5 sectors that we put out here, that they have had a consistent earnings growth despite any cycle. What these colors indicate is that every year there has been, if it's a high deep red color, it's a loss. And if it's an orange color, basically it means that earnings have degrown in that sector, right? What we're trying to showcase is the place where it is all white. It tells you that the sector, irrespective of the cycle, has managed to show you earnings growth. And we want to be focused in this area because we want to buy sectors which is counter-cyclical. So when the economy goes down, or you have hyperinflation, or you have whatever the case is, you want businesses to continue to thrive, right? And that's exactly what it tells you on the top box out here. Whereas you notice this other thing as well, Nifty 500. Nifty 500 had 1, 2, and 3 years of earnings degrowth. And why do we tell you to play consumption? Is because it's counter-cyclical. So when Nifty 500 is degrowth, look at the consumption space out here. It continued to grow earnings, right? So this is what it does. So when you invest into your mutual fund, it invests into everything, But at times you want to have a counter-cyclical play, right? Wherein it doesn't fall or it doesn't do as badly as the large economy. So that's one of the reasons why we keep telling investors that this should be an important part from a wealth building perspective from a long run.
Hemant, I'll just step in and take a question over here. Lot of time investors ask us that isn't ETFs the only answer to investing for long term? I just pick up a Nifty 50 ETF or the next 50, the junior Bs, or probably any ETF. So I think what you showed in this slide, that at an index level, there could be earnings degrowth. But if you have focused on a particular style or a particular sector, you can have years where index is degrowing, still your portfolio is less volatile and still the earnings of your portfolio is growing. So if you would just want to answer this question, which we constantly get on ETFs.
So for ETF, I think I'll just step back on this slide as well. So what do you do when you buy an ETF is you're buying the Nifty 500 out here, which is the red dot, right? This first part out here. Unfortunately, then effectively you're buying the overall economy, because when you buy a Nifty 500, you're basically buying roughly 80% of market capitalization, right? If you're buying 80% of market capitalization, your performance should be roughly close to the economy, which is around 12 to 13% as how the nominal growth rate of the economy does, and best case, right? So one is that you're subjected to a lower return, right, when you buy an ETF, because surely you have to buy everything. Now, buying that everything means that there will be many sectors which are going through stress, right? And it counterbalances it. But the point being that Nifty ETF, while it has lower cost, the returns are less. In your earlier slide, which you showed take case to investors, right? You showed one thing, that 12.7% compounded return versus 15.7%. And the difference is the 3%. That's exactly what I'm trying to tell you. That if you're going to play the 12.7%, you buy the ETF. You want to be the 15.7 to 20%, you buy the space out here, right? That's how you would go about it. And the second part of it is, yes, in terms of earnings volatility, the trying to buy something which balances your portfolio is extremely important. Like when you do an asset allocation and you're just buying the market as a whole, it's fine. There's nothing wrong in it. But if you want financial independence, you need to buy into sectors which can thrive and continue to outperform this declines which will happen. So in a larger sense, I hope to have answered that question.
And I'll just add, because there's another question around why not just take consumption ETFs. So in that sense, just the same logic that Hemant explained about the Nifty 500 ETF versus looking at some sectors in the consumption space, for instance, to give you a higher return. In the same logic, if I extend, the consumption ETF again would probably be across multiple companies in the consumption space. So even if we had taken that 230 companies, suppose were in the consumption ETFs, the return would be limited to that return of the consumption ETF, which would still be higher than the Nifty 500 ETF over a longer period of time. But what Hemant is now going to get into is actually what we call the super subset. And that will explain to you why some companies should be looked at more closely versus then broad basing your asset allocation into just ETFs, even if it's consumption ETF.
Yeah, Nehal, I'll just get on to this. And
yeah, sure. A little louder, Hemant, just a little louder.
Sure. Is this good?
Yeah, better.
So what we did was, well, it's all nice to see, a top-down view, right? Sometimes we need to go bottom up, right? Trying to understand businesses and then look upwards. So what we did was, we said, this was 2 years back, we did a research on the Nifty 500. And we said, can we pick up businesses which have done extremely well at times when the markets were in stress, the economy was in stress and businesses were in stress, right? And I'm talking about right after the global financial crisis. And I'm talking about exactly during the change era of the NDA government, right? And we spotted 70 companies from this BSE 500, which managed to show exemplary earnings growth and performance, right? Then just recently we said, well, let's look at the B2C space. And we said, out of the universe, are there any B2C companies which have done very well even during the pandemic phase, right? Imagine there are so many businesses which shut shop. Yet we found 32 companies which managed to deliver earnings growth, maintain capital efficiency, and gain market shares and grow their business in a phase of 2019 to 22. We call this as a super subset, right? What did the super subset do in terms of performance? Well, during the last 13 years, the earnings growth of the super subset was 26% CAGR, right? And Nifty in the last 13 years, the Nifty 500 grew only by 12%. So Nehal, to answer your question, right? Why buy Nifty 500? I mean, the question I would again ask you on the other end is, why would you buy a substandard performing asset class, right? Why can't you actually buy a Mercedes-Benz when you can, right? It's not expensive, you still can buy it, but why would you want to go for an underperforming vehicle, right? So that's the thing, right? And you are all interested, I mean, all investors, including us, we have our wealth as well invested in Alder Capital. We are interested in compounding over a long period of time, right? And we want surety. We want basically less volatility. We want businesses which have very high competitive advantage. That's the key narrative, right? How do you get these businesses? They should have extremely high competitive advantage, and they should have management which has very high level of corporate governance. So there are two things that we look at when we look at businesses from bottom up, and that's what we call them as a super subset, right? Where managements clear all hurdles, they turn out to be the best in their industry, they tend to continue gaining market share, they always are able to expand opportunity size set and grow the business irrespective of where the economic cycle is. So that's what we keep saying, that you rather invest in this than the overall market. I'm giving you a few super subsets companies so that you get a flavor of it and try understanding it. And made it very simple for everyone to understand. That if you look at the blue color line, that's the share price, and you look at the maroon line out here is the EPS, earnings per share, right? You notice that the blue and the maroon eventually, at every step of the way, they tend to marry. It's like gravity. Share price is a slave of earnings in the long run, right? No matter what you do, right? Eventually, it will come back to it, right? So if you notice the earnings compounding, which has been happening out here, right? In the last 2009 to 14, earnings of Abbott actually grew by around 27% per annum. Share price grew by 35%. If you notice, similar pace was maintained in the next two phases as well. Over a long period of time, which is what all of us and where it all matters, is that while earnings grew by 22% per annum, and mind you, Abbott has been growing in revenue-wise by around 10 to 15% per annum, right? So it's nothing phenomenal. It has been growing at the pace of the economic growth rate of our country, nominal growth rate of our country, right? But is managing to show you an earnings growth of 22%, which leads to a 34% earnings share price appreciation over a long period of time. And one might consider it as not very exciting, but this is exactly what we want. We want boring businesses, maybe, which people don't necessarily talk about every day, and it keeps doing its work. Another company that we have controversial of lately, people love certain banks, people hate certain banks. HDFC has been out of favor, right, of lately. But just look at what it's been doing in terms of earnings over the last 13 years. It's managed to show you 22% CAGR earnings growth rate. Share price is still 23%. Now, this is the funny aspect. In this last 3 years, earnings have yet managed to grow by 20% per annum, but the share price has grown only by 8%. What does it tell you? It tells you that, well, at some point, gravity will pull you back, which is upwards. The share price will move upwards to earnings at some point. And when will that happen? It'll happen maybe after the HDFC merger, after everyone has all their concerns addressed, and HDFC looks like an Axis or an ICICI bank with a housing portfolio sitting inside the bank, right? All these banks have a housing portfolio inside the bank, but everyone had a problem when HDFC is going to merge with HDFC Bank suddenly, right? So all I'm saying is, once it gets merged, even a Bajaj Finance has got a housing portfolio within it. So that will change. So one has to be patient. When you're buying something like these, right? Look at only the maroon line. If you are doing the step up on the maroon line consistently over a period of time, you will have your repricing when it happens. So banking is a space where we believe that there could be a 25 to 30% earnings growth for the sector as a whole for the next 3-4 years, right? As interest rate cycles are moving up, margins are expanding, appetite is growing, and credit cost is coming down. While that is happening, I mean, it's highly unlikely that the 3-4 private bankers are just not going to do anything, right? They have to do something, because if you believe that the fundamentals are going to play out, it's going to work through. So this is again another investment we have. Britannia.
Hemant, I'll interrupt because every day, I have investors asking me, HDFC Bank we are holding and the price is between 12-1400. We are seeing no return since last 3 or 4 years on HDFC Bank. So, I think hopefully, this slide explains them that we have to focus on earnings growth. Till the earnings are growing today or tomorrow, the share price will converge with the earnings growth, and they will see a big return in HDFC Bank also.
So, I mean, it's like a cricket team, right? Not all players can perform at the same time. You will have a few players which are like the pinch hitters, like your commodity sectors, which will have once in 7 year or once in 8 year rallies, or you will have IT sector, which did very well. But then you also have the Dhonis of the world who will be sitting right at the back, right, and doing what they are doing, and they will come in and perform when they're supposed to do it, right? So all I'm saying is that you need to look at, like you said, earnings growth, be patient, right? If the fundamentals of the business is doing well, don't be worried about it, right? That will happen. And I always have seen this, at least in the last 20 years that I've been in the markets, that, suddenly stocks tend to give you all the return in single year. And it makes up for all the last 4 years that, you have waited. At that moment, you'll say, oh my God, now it's got again a 20% CAGR returns in the last 5 years. Well, you should have waited all the way through to get that benefit, right? You can never time it. It's very difficult to time these things. But you see value, that's when you should be in it. In fact, if somebody had not restricted me, I would have added more HDFC Bank in my portfolio, but we have our own internal limitations. So another boring business, Britannia. This again, like you can see that, earnings compounded at 20%, share price compounded at 27% over a long period of time. I mean, we love boring businesses. Right? What it does is it's supposed to do the job in your portfolio. It's like pillars. It just stays there and it keeps giving you returns over a long period of time. Now, Britannia, if you notice the maroon line, after many years, it has a drop in the maroon line. One of the reasons is that it did phenomenally well during the COVID phase, because when people were in the mass exodus, moving in from the urban to the rural areas and buying biscuits off on the transit, this category exploded, right? And that's why the profits did well. But it doesn't mean that they have lost competitiveness. It doesn't mean that they're still not 40% of the market. They're still growing. So I think that's business like these also, where especially food in the staple category, we are very excited about. We don't own Britannia, but I've just shown you as a representation that it lands up in the super subset.
Thanks. We own Britannia in almost all portfolios. And again, from a peak of 4,200, it went down to 3,000. I think it's at 3,600. We still continue to hold. And many times you ask this question about Britannia also. So I think luckily you are, having a lot of examples, which a lot of us already own. A lot of doctors also already own.
So food is something that we're very kicked up about, packaged foods in India. We think that the earlier part of the decades, and I'm being a young consumer analyst, I used to travel the world and I tell people that, why don't you buy personal care products and soaps and detergent companies and all that. But quite honestly, I think while many of these categories are penetrated like 99, 98%, detergents and soaps, the volume growth rates are not going to be as exciting over a period of time. But for foods has got an immense potential still in India, right? And in that, the scale is can be much, much larger from where it is right now. We are the only market in the world where the size of packed food is lower than the size of home and personal care market, category, right? Every other market in the world, the size of packed food is much larger. So a lot of scope. I think that's the right place to be from long run. So I'll summarize this and I'll open the floor for questions. I'm sure all of you might have a few. let's look at the summary out here. What we are saying is that consumption is still a structural story. While India grows at 13% per annum nominal terms, consumption is likely to do a little better across subsectors. So it's a very integral part of the overall theme in India, and thus what's driving our economy, which is 60% consumption, right? Is B2C cycle at the worst ever phase? Yes. As my 22 years of history as being analyst and a fund manager, the worst phase I had seen in consumption was way back in 2002 and 2005, right? That was a phase when people used to call fast-moving consumer goods as slow-moving consumer goods, right? That's because rural areas had multiple droughts and many other category collider issues. This time around, again, never thought that we'll get to that point, but pandemic did it, right? 2 years in a row, it's demolished growth rates, not because the businesses or consumers had no interest in buying these products or services, but the supply chain was impacted in a large way, right? And consumption was impacted in a normal sense. So I think we are at the lowest phase in our decadal cycles, right? And right place to look at from a multi-year growth rate. We saw many sectors. We are very bullish about retail, healthcare, BFSI, and consumer tech in the next few years, right? Many reasons, because many of these sectors are highly underpenetrated, sectoral leaders, and mind you, sectoral leaders have traditionally done extremely well in every sector that we have seen, right? And they have only improved the competitive advantage over a period of time. So while we look at these sectors from a long run, we also like to look at sectoral leaders out here. And finally, to put it, if you were to build a portfolio of businesses which are got high competitive advantage and run by outstanding managers, then I'm sure that the portfolio will create value. Why do I say this? Is because when we look at our own portfolios, when we forecast our earnings growth for these businesses, they are likely to deliver at least a 20% earnings growth, right? When you have a 20% earnings growth in your overall portfolio, in a larger sense, value, like I showed you in the earlier charts, also will gravitate towards that. So in a larger sense, expecting a 20% kind of portfolio appreciation for a consumption business is not out of the ballpark, right? It is squarely there. You might have a year where it might not perform, even from here. But if you look at it from a long run, to get that golden benchmark level which Nehal had put out, 15.7% is hands down, one can do it, right? It's not difficult. So it's an exciting sector. We have been excited about this for the last decade. We are still excited about it as we go. With that, I'll hand it over to you, Nehal.
Okay, there are a few questions. We'll start with that. First of all, wonderful presentation. And I think it really gives a lot of clarity that how the whole market is structured, and majority of the market is business to consumer companies. So instead of wasting time on focusing on the second half of the market, which is very cyclical, and you really have to be very watchful to understand, are you at the top, middle, or the bottom of the cycle? Instead of that, why not be in that part of the market which is expected to grow consistently, and focus on companies, like you said, which have a very high earnings growth. So I'll just start taking the questions. One question was from Dr. Nikhil Dattar, that the question was, why not look at cyclical companies? I think at the end of the session, I'd request the speakers to comment on why consumption and why not IT, chemical, pharma, infrastructure, and other sectors. They are also equally growing.
So it's like, I'll put it very simply. It's like what Warren Buffett and Charlie Munger of the world say, that to make wealth, right, you can invest into one of the most boring businesses, like utilities, right, and still create an enormous amount of wealth for yourself over a period of time. So it effectively says that you don't have to be jack of all. So long as you have expertise in a few areas, and that's exactly what we have for the last 20 odd years, we rather play this, because we know this, we know the promoters, we know businesses, we know consumers, and we have studied them more closely from the bottom up. And therein lies this our expertise to build wealth for ourselves on this. Going back to the question, there's nothing wrong in B2B businesses. I'm not going to come on this forum and say, wealth has not been created by B2B businesses. They are created. IT businesses have created wealth, right, over a long period of time. Exports, pharma exports also have done it. You asked me about chemicals. Chemicals have gone through one of the best super cycles they have seen in a lifetime. I'll be cautious over there because these super cycles are created by disruptions in demand and supply, just like other commodities. These commodities have their own 7-8 year cycles. So you have to be a real expert to catch them at the bottom, sell them at the top, and look around for something else. So while they might create value for other fund managers, we don't look at it. We rather are interested in, so long as we can achieve a 17-18% compounding on a yearly basis, we are very happy. We'll sleep well at night. And so will our investors.
Just to summarize what you said is on the expertise. Like, for example, we have a lot of doctors on today's chat, they have an expertise in pharma sector. They probably know pharma companies better than all of us. Like they know Abbott or Cipla or generic better than us. So I think for them, it is better to really dive deep into that sector and then find out companies where they know what the companies are doing. They know the management better, or probably they'll know something more than what you and I will know about the sector. So what I get from your answer is that we should play on our strength and we should focus on companies or sectors we have expertise on. It's not necessary that we be all over the place and we have like infrastructure, chemicals, IT, because it's not possible for a human being to have expertise in all sectors. Like, for example, if I look at myself, because I've been in the BFSI industry for 2 decades, it really, the industry from the back of your mind. You know what the leadership of ICICI Bank is with Mr. Sandeep Bakshi, or who is at the helm of Bajaj Finance, or the sector that much more closely, like in the housing finance or in the BFSI. So we worked with companies like IIFL. So I know the management is so good. If they've started IIFL Finance, I'm sure they'll do very good. So that we have like an inherent experience in BFSI because we have been in the industry for 2 decades, and I can really know the management, know what they're doing, what is the impact of that product or service on the market share. So I basically focus on investing more in BFSI. Is like playing on my strengths. This is what I think we are trying to tell everyone, that it's better that people play on their strengths rather than being in all the sectors.
Yeah, and just one more thing to add to it, I would also caution and urge that the onion has to be peeled a few layers. Just because we have expertise in and we like some business, right? For instance, you did mention about pharma sector, right? And if you did really see the value creation, which many of these MNC pharmas have done over a long period of time, they wouldn't have actually created significant value. So I know of some investors with us who run also a pharma portfolio because they're doctors, and they have bought all pharma businesses. And many of these have struggled to create value because the MNCs in India view Indian markets very differently from how they view a US market or any other developed market. So I'm just saying that building expertise in a sector means giving also disproportionate time to understand it as to how some of these businesses, while they have been doing great from a product basis on marketplace, how are they doing financially, right? Then to see whether they have been compounding assets, compounding their earnings, they have been gaining competitive advantage and growing as fast as what expectations are. These are things that we need to spend a lot of disproportionate time to understand that is that achievable or not.
Okay, thanks. And I think this one more question: how to study the relative strength of the sector?
Many ways. I could have another full discussion on this, and that's a topic that we debate on a daily basis. So I'll give you a simple example. Relative strength in a sector, like I said, is you've got to understand which cycle the sector is in, right? If it is a sector which is in the maturity phase versus a sector which is there in its growth phase, right? You rather want to be in sectors which are in its growth phase, because in a maturity phase, the competition pricing power is all much more limited, and the potential to grow and expand is also limited. So that becomes a problem. The second thing that we understand from players, and I'm giving you a few bits and pieces out here for you to get that understanding, as we look at relative shares. Generally, some of the leaders in the sector are 2 times the nearest competitor, right? Or they would be 3 or 4 times the second nearest competitor. And they would be gaining share consistently over a long period of time, right? So we like to look at those kind of leaders, or you could have even a new entrant who has actually been gaining share from the next 2, 3 other players. So we like consolidated industries among the organized players, right? And we like leaders to emerge out of it. We like businesses which are basically in the growth phase, where pricing power is relatively strong. So few bits, but this is how we go about actually figuring it out.
It's some questions on why compare with Nifty 500 instead of a Nifty 50 ETF.
Nifty
So
5.
the one aspect is, which I answered on the other chat actually, Nifty 500 represents 80% of the market. Nifty 50 is only large caps. And if you want, and if the question is, if one has to look at the earnings growth, even of the Nifty 50, I think over the last 12, 13 years, it has still been around 12, 13%. This is after the fact that, the last 2, 3 years would have actually bumped up, because prior to that, we were all saying the Nifty 50 has only delivered barely 5, 6% over the last 8, 9 years. And during the COVID phase which we showed, where Nifty 500 gave an earnings growth of 24%, the Nifty 50 largely would have also contributed to that earnings growth, because we saw the commodity super cycle happening and BFSI also kicking in during that phase. So on a long-term basis, Nifty 50, 500 still around 12, 13% earnings growth, but 500 gives you a more dynamic of the entire market.
Someone has logged in again from my ID and written, metals, cyclical, pharma, chemicals are also consumables directly or indirectly. Why the chat has come from my ID, I don't know, but there's a question on this.
So we consider B2C is direct sales by companies to consumers. And why do we consider that? Let's understand this. So when you are a company and you say that you are supplying X pharmaceutical, or let's say X chemical, to a company, like let's say that you are supplying chemical products for liver to make soaps, right? And you're supplying chemical products to 20, 30 other companies like this to make soaps. But they are going to be 20, 30 companies, out of which maybe the 1 or 2 companies will constitute at least 20, 30% of your revenue. Effectively, your pricing power is limited, right? Because you're selling to liver who is 10 times or 20, 30 times larger than you, right? And the pricing power is limited. You will be succumb to commodity pressures. There is very little differentiation that you can do in a commodity, right? When you're selling it to liver. But just think about it. When liver takes that product and converts it into a soap and sells it to a consumer, right? And you might want to think about this, that all soaps are relatively the same eventually, right? Why is it that you buy soap A versus soap B? And why is it that you want to pay more for soap A versus soap B? Because of the brand, because of the positioning, because of the connect, right? So what we are saying is that, yes, many businesses are B2B2C, but we don't like B2B2C kind of businesses because they typically have a lot more risk. They have business risk. They have low brand equity, they have low pricing power. These are typically which comes along with B2B2C, the kind of businesses. Whereas all of these are far more prevalent and stronger in B2C businesses. And that's why they create far more value consistently. That's the narrative out here, over a long period of time. We don't want businesses which only create value in 2-3 years, right? And then you come back and say, oh, can they create value in the next 10 years? The question is a question mark completely. If China tomorrow decides to set up its all manufacturing plants for chemicals because it's going through a recession and is going to do everything possible to grow, right? You think chemical prices will remain where they are? Absolutely not. It will crash. If the global economy goes into a recession, things will crash, right? Because demand actually has a follow. But will people stop consuming packed foods? Will people stop consuming cars just because there is a recession in Europe? I don't think so. So that's the broader answer, that we like B2C businesses for that main reason.
There is a question that pharma is also consumed by people directly.
Yes, we like branded pharma. We don't like export pharma. So we like branded generic products. So we look at all companies which are Rabot, GSK, Sanofi, Pfizer. But we don't like companies which are catering to bulk drugs, which are only to the US and the European markets. Let's say DVs or the Lupins of the world. While they do have a certain amount of domestic portfolio, but the larger portion of the revenue is from exports. That's one of the reasons why we don't invest into those businesses.
There is a question which is coming again and again on the concept of superset companies. So if we can have a little more detailed discussion or more clarity through more examples.
So super subsets are, so what we call it as is that when the economy went into stress, remember I showed you a chart where it said that GDP of a country in the last 3 years, right, has managed to grow only by 1.7% CAGR, right? Effectively meaning that our economy has barely grown. In that time, the Nifty 500 managed to show you revenue growth of only around 8% CAGR, right? What did the super subset do? The super subset in the consumer businesses, despite having many businesses shut shop, right, managed to grow much faster. And why is that the case? I'll give you an example. DMart, right? Now, we all know that in the Q1 of FY21, first quarter of financial year 21, and the second, again, the first quarter of financial year 22, many stores were shut for DMart. People just couldn't go and shop because of COVID protocols, right? And yes, if you imagine that in any business that you say that 3 mahine ke liye aapko, you will have to shut shop and there's no business, then what would happen to the earnings? So typically these businesses will go into a mess and earnings will decline and you will have an issue. DMart, while that was the case, it was still growing and expanding its stores, right? It managed to show revenue growth rate because it said that, well, that can be the case for two months or, but does it mean that the potential for India is gone? So it still expanded into cities, it expanded stores, it reduced its operational cost. And at the end of FY22, mind you, I'm talking about just at the end of a COVID year, right? It still managed to show you over 20% earnings compounding on a revenue which was 2x that of Nifty 500. Now that's a classic super subset company, which is able to show you at high capital efficiency growth, despite having the most adverse cycle on it. You can imagine that. In a normal year, they would have done wonderfully well, right? But in an adverse cycle, if businesses are able to do extremely well, that's what we really call them as a super subset. That and that's how they stand out, right? There's no marks for, in a rising tide, if all the boats are going up, there's no marks for it. But in a whirlpool, if a boat is able to step out of it, right, and stay afloat and do extremely well, that's how we look at it. Saying which are the businesses which are able to come out of a storm and grow faster than its peers and do very well. And mind you, in that time frame, you had businesses which collapsed. Future Group, let's not forget. So
yeah, I just want to add here, just one key takeaway is, while we have discussed FY19 to 22 being the worst phase for consumption businesses, the phase from FY9 to 19, which is a decade over 10 years, consumption, those B2C plus BFSI businesses delivered 2x in earnings growth compared to the Nifty 500, meaning that in a phase where things will come back to normalcy, you will see these compounders in B2C businesses giving you far more earnings growth than the overall broader market.
And Rekha, to add to that, what Rakhi has said is super subset are companies which come out in many sectors. It's just not one sector in consumption. They have come out in consumer staples. They've come out in healthcare products, health services, retail, footwear, apparel. I mean, name it. They've come across sectors. So it's not like, one will say, oh, only this sector is doing well, but they've managed to do well in, these companies have come through every walk of consumption category, right? So it's important to try to figure those and then stick with them over a longer period of time.
A question not from the chat, but from my side that, right now there is this whole thing like the Indian markets as such. Because of COVID, people had a lot of time and they were sitting at home and attending too many training programs and all. And what people think, like the market is confused. Should they actually take professional help or should they be DIYs when it comes to managing their money? So Hemant, I wanted to know from you that for you 24/7, 365 days, it's about fund management, research and all. So how do you go about your day? And is it possible for people who are not specializing in fund management to be able to actually give that much time? What goes into your job as a fund manager? And this question is both to you, Hemant and Rakhi, because I don't want people to be misled that everybody can be a DIY and they should trade their time from their profession is so much into actually sitting and doing micro research and managing their money full time. Like there is one school of thoughts which tells people that you should be DIYs, but there is another school of thought also where, if you ask me, I run Finovate. Okay, that is my core thing. My core is to run Finovate. When it comes to managing my money, that's passive. And there is only a limited time which I can invest in actually researching, talking to consumers, competitors, management, all that. It really requires a lot of deep research. So I wanted to know from you all as to what your job looks like, and is it practically possible for us to leave our jobs and do what you all are doing?
I mean,
no, if you leave your jobs, if all the doctors on this platform leave their jobs, who will take care of us when we fall sick? So in the same way, I'll use that analogy that while our doctors here are, keeping us healthy from our bodily, whatever we have, mental and bodily issues, the same analogy we should put for financial advisors as well. Are they the ones taking care of your financial health? So, where it is their day-to-day job to look at it from a financial point of view. So I think this is the easiest analogy to give to our audience here today around that. But just before Hemant, gives his insight into this, I'll just tell you from a day-to-day perspective, because I'm looking at businesses not only, individualistically, but looking at a sector as a whole to see and compare the relative strength of A business versus B, C, and D businesses in that sector. And then going up to the industry level and seeing what trends are happening at the industry level as well. As, so there's a lot of work and hard effort that goes into identifying great businesses. It's a journey, and it's not that one time you've invested, it stays with you forever. There are changes that may happen, that may come about all of a sudden because of some regulation change, or it may happen because some new competitors are coming into that industry. So one has to constantly look at and see how the environment stress tests these businesses continuously. So I know a lot of comments have come around by saying that why just not invest in the ETFs if, on an overall basis. Yes, if you don't have the expertise, then please go ahead and invest in the ETFs, because that's probably the easiest way for you to at least earn some return, which is better than an FD return. But if you have, if you're banking on some financial expertise, they could probably deliver you better than the ETF returns.
Yeah, so I'll just add to what Rakhi said, and you used the word which was very important. Is the key narrative out here is time. right? So I categorize that this is how I look at the investment universe. I tell people that, well, generally all of us have, who are investing into equity markets, would have an above average intelligence to spot the right businesses and to, decide that this is something that we or maybe something that we have seen it on a day-to-day basis, and that's how you get familiar with the business, product, or services. And over a period of time, as you read, you will have that intelligence to invest in these businesses. Like Raki said, once you have decided to take a call, well, you must have peeled the onion one layer or two layers, but it's important to peel it many more layers, right? Why do I say that? Is because it leads me to the next point, where if you haven't peeled the onion many layers, you would not have conviction. And what do I mean by conviction? You will invest maybe 1-2% of your wealth into it. What is the point in, after learning and understanding about a business, and investing just 1 or 2% into that? Now, if you're going to do that, right, and you're going to invest into certain other business, why it might not be great, it levels out. It doesn't really add value then to your overall portfolio. So what we try to tell investors is that in order to develop conviction, you need to do thorough research. What does it mean? Like Nehal, you just said that you need to meet consumers. You need to meet multiple competitors in the sector to understand their strategy as to what are they doing differently to gain, right? You need to meet ex-employees to understand that the business has got the right culture and the people to, as a custodian, to take care of your investment, right? Your share of the stake in the company, minority stake. All those things are extremely important. It's just not good enough to look at an annual report and say, I think this is great, right? And there are many businesses which will look great on paper. And unfortunately, it might turn out to be completely different when we step down on the ground. So that, and then finally, the third level, which is called as patience, right? I had spoken to you about this earlier on as well, that, at times you could have a situation when the stock that you bought and you've done thorough research might fall 40-50%. This has happened to some of the super subset companies that we know of. Why does it happen? It happens because suddenly the markets are in a adverse, risk-averse environment. And when that happens, the key question which many of the investors will ask is, have I made the right decision? And some of them manage to sell that in stock at that level. But if you did have all the conviction, all the insights that you had, you will actually step in that moment and add at that level. And really, that's where the returns comes through, right? Over a longer period of time. Not exactly just waiting. You make excessive returns is when you play these panics. And that happens only when you have thorough conviction. So my long answer to your short question is, everyone can do it, right? But not everyone can do it the way it's supposed to be done. Right? And for that, you need to spend a disproportionate amount of time. If time is not there with you, then it's going to get even harder when market sentiments are adverse and when you don't have the appetite.
Thanks. It really answers the question that, we want to be neutral, not promote any one school of thought. We should present both school of thoughts and let people make a better decision for themselves. So like you rightly said, that you have to weigh this decision with the amount of time which you can invest and whether you can. I think that onion analogy was like very good. Can you peel in so many layers? It's not that the one layer or two layer. I just read the annual report and decide it's a good business. In fact, Dr. Dilip Raichura was asking that how do I differentiate between a DMart and a future retail? I think this example of yours really, it's not on a 1 or 2 layer future retail look like a good business.
I'll answer that question, Nehal. So when DMart came for an issue, so we are investment bankers. Raki was in the investment banking field. And I'll give you a story about it, so how we've developed our conviction about it. So we have been looking at many retail businesses, right? I have been instrumental in, and Raki as well, we've been instrumental in listing of the Future Group, listing of Shoppers Stop. Many businesses that you see today, we have been part of, right? So when DMart was coming up for issue, and we had seen this 5 years before it came up for issue, right? At that time, Mr. Damani was having a very fledgling business and was doing something interesting, but in a small market. So the big question that we had was, DMart is known only in Maharashtra and Gujarat. Now, if DMart really wants to scale and become a national player, will someone from Bangalore buy DMart or buy into the products that DMart is selling? So we said, okay, let's do this. Let's take a 2-day tour to Bangalore and let's go and sit in one of the DMart stores for the whole day, or just go behind in their store area and speak to those managers over there and just understand what's really happening at the ground level over there. So we did that. What we came back was far more interesting. This is all before the IPO I'm talking about, right? You don't do work when IPO is out and this thing. You have to do a lot more work before everything happens. And we came back, and the revenue per square feet, what DMart was generating, was 32,000 rupees per square feet. The difference that my learned friend would have asked is, what's the difference between the Future Group? Future Group was generating somewhere around 12 to 14,000 rupees a square feet, right? It's 2x. And there is no marks to understand that when you're doing lot more revenue per square feet, right? Your profits are even more because you can reduce the margins, pass it on to the consumers. The consumers love that low margin products and cheaper, better value. So they come to DMart even more, right? It's a virtuous cycle. That because you offer better value, you want to run to DMart more than you would run to any of the other stores. And that's what we noticed, that if in Bangalore, which was a new store, it was open just a year and a half, it could do actually better throughput than Gujarat, where we know that the throughput was slightly lower, then, well, Eureka. I mean, they can go any part of India, because what is that Indian consumers want best? It's value, right? And if you are able to provide best value, you can do the best asset turn. So that's one of the things that got us all latched onto it. We own DMart since the time it's got listed. And many times that we thought we should sell, and we should slap ourselves on our wrist, saying, again, if you have a super subset, what are you doing? Right? You're building wealth for the long run. Yes, it is expensive. I'm going to be out very open in this forum saying it is expensive. It's probably one of the most expensive stocks that we own, right? But does it still look like it can compound at around 18% over a long period of time? The answer is yes.
I think, Rakhi, you may want to take that questions which has come on that consumption, MF, small cap, something. Could you please comment on comparison of returns and CAGR of the consumption space versus small cap, where the small cap MFs have performed much better than the consumption MFs recently?
Yeah, so it's just iterating the point that we were sharing earlier, wherein we said that, the GDP has grown only by 2% over the last 3 years. Consumption businesses, B2C businesses only grew earnings CAGR of 5% versus the Nifty 500, which did 24% in that same phase. So Nifty 500 includes the small caps as well. Unfortunately, during this pandemic phase, as Hemant mentioned, a lot of the B2C businesses had to shut shop. And during the last 6-8 months, all of us know about the margin pressure that these B2C businesses have faced because of higher commodity prices. So the smaller ones, especially, who don't have pricing power, would have faced more margin pressures than the larger ones, or the better run businesses which have moats that can pass on that pricing pressure that they are feeling. So in the sense, you're right that on the last 3 years, where we may have seen small cap doing better than the consumption mutual funds, is largely because consumption has gone through its worst cycle pretty much. But does that mean going forward? I mean, just to reiterate the first comment that came on this, don't look at historical, returns. Past performance is not a gauge of what can happen in the future. If consumption has gone through its worst cycle, and we are a consumption-oriented economy, 60% of our GDP is consumption, there's no way that the GDP can grow without consumption coming back to normalcy.
Okay. Again, there is a question on more companies in the super subset. If you can name a few, and I think once again, I just read out the question from Dr. Dattar. Please give examples of super subset companies from consumer, IT, and pharma. Pharma, you have given one example, that is Abbott. Do Affle, Tanla fit into your super subset company ideologies? I think a lot of people are trying to ask that how can they identify super subset and do all these companies form?
So simple parameter that we used to shortlist was basically earnings growth, right? And revenue growth also. The super subset that we are talking about, the 32 companies, is in the B2C space. Just to answer this, Affle and Tanla don't come under a B2C space. So that's why they would not be considered in that 32 company super subset. Secondly, on consumer IT, a lot of the consumer tech companies barring Naukri, which are listed, are loss making at this point or barely profit generating. So they would not have shown earnings growth over the period that we are talking about because they're loss making. So clearly they have been excluded from that analysis in current analysis. But nevertheless, consumer IT, if they do what they're doing and they continue to focus on their profitability growth aspect, they can be large generators of profit over the coming years. And that's exactly where looking at past historical data can be a little bit colored because you're not seeing the emerging trends coming about, which could generate high returns in the future.
Yeah.
Go ahead, add.
I'll just add directly to the question that was raised. I'll give a few names. Won't be able to publish the entire report out here, but to give you a flavor, we'll look at foods. Nestle does land up in that along with Britannia, right? If you look at apparels, you have Page Industries. You look at retail, you have Avenue, you have even Titan, which actually lands up. So these are some of the names, right? I'm giving you in some sense that there are many others like this which really show up. And when we are doing this comparison, we are comparing them with large, mid, and small. We are not doing this comparison only with the large caps alone. So when we say that we have taken the entire 230 companies in the consumption universe, you can believe me, it's practically anyone and everyone who has got 500 crores and above market cap, right? Which would land up into everyone's investment portfolio at some stage or the other, or investment screening list, I would call it as. So yeah, I mean, we've been saying this very openly that in every sector that we looked at, and the chart that we had given, right, we had given you multiple sectors that we look at, right, from healthcare services to foods to staples to apparels. The leaders typically have done a far better job. I mean,
yeah. And just to add, leaders doesn't mean only large caps. Just to address that question, the super subset includes a lot of mid and small cap companies as well, because you could have leaders in the mid and small cap space who are leaders in their industry. So footwear companies, you have your consumer durables, or even your home improvement companies, they all feature in that list.
Just give one or two examples of mid and small cap, because I think what people understand that we are talking more about large caps, which is not the case, like you rightly said.
So Dr. Lal is there, is a mid cap.
Small cap would be, yeah, I mean, mid small cap like Relaxo also the features in. So basically we use a definition of a mutual fund, right? To be clear out here, when we say a small cap, I think the mutual fund definition, Rakhi, if I'm not mistaken, is around 9,000 crores or something like that. The decent
8,000. Yeah.
So anything below 8,000 crores and anything below between 8,000 to around 20,000 crores is the mid cap, right? So what I'm trying to say is that if one is looking at 1,000 crores and 2,000 crores, they become micro caps, right? In the larger scheme of things, we don't have. At least in our portfolio, we don't have investments in micro caps at this stage, though the analysis spreads across small, micro, mid when we did this.
There's that one question, are stocks trading at more than 50 PE worth buying over a longer period of time or whatever?
So this is a good way of understanding business, right? And I use this for all my interns who actually come in, and I give them business A and business B. Business A has got revenue of 100 rupees and profit of 50 rupees, right? And that's a huge profit margin, but profit of 50 rupees. And let's say you value it at 10 times. So you're valuing the business A at 500 bucks. But at the end of the year, business A will keep investing out of the 50 rupees, 40 rupees back into its own business, right? So effectively, the free cash that business A is generating is only around 10 rupees. Let's look at business B. Business B also does a revenue of 100 rupees, generates a profit of let's say 30 rupees, correct? Lower profit than business A. But business B doesn't need any capital going back into its business. So do you think business B should be valued more or less than business A? And our answer is that you look at business B will be valued maybe 3 or 4 times more than business A. Times I'm talking about. So if business A is valued at 500 rupees, we would value maybe business B at 3,000 rupees. Why is that? That's because in one way I'm trying to tell you is that what we value on the world is free cash flows. That how much is the owner able to take back without it getting reinvested. So P&L profits are the worst way to see value. People do see it because it's the easiest metric. And when we look at consumer businesses, all of these consumer businesses are free cash flow businesses. They look like business B. And that's why they tend to have a higher value. So let me give you an example. Nestle, right? What is Nestle's PE today? It's somewhere around 60 odd times. As Nestle,
80, I can say between 80 or 100, if I'm not wrong. I've not seen very recently, but yeah, around that level.
no, I'm saying it on
historical, yes, but on a FY23 going forward.
Looking at a 23 basis, so like current year value kind of a thing with our forecast. So when I look at it historically, and if you look at it last 10 years and last 15 years or something like that, you'll notice that Nestle's PE has always been elevated. So markets can be stupid or illogical 1 year, 2 years, 5 years, 10 years, but 10 years is a very long phase for markets to be completely illogical. This is how global institutional investors value businesses. So don't go purely by PE. That's first thing. If you're a free cash flow business, the PE is bound to be very high. Otherwise, what would happen is that you would have Tata Steel valued at maybe 50 times more than where it is today. I mean, why on earth would Tata Steel be valued at single-digit PE? One should go back and reverse ask that question. Or why on earth should an HDFC bank should be trading only at around 13 PE or 15 PE, right? So I'm just saying that, certain businesses are free cash flow. They will always tend to be at a higher value.
Great. So I think it was a very good Sunday morning and we've answered a lot of questions. I've even asked everyone in chat that this was a part 1 of the webinar. The part 2 we may have in 2 weeks time. So you all are free to send us your suggestions as to what do you want us to cover. Someone has said that they want you to talk more on the sector and how can they look at like the sectors. That is one suggestion which has come up, but even more, if any other suggestions, you all know our coordinates, you all can write into us. And we look forward to one more session, maybe next weekend. Hopefully we'll announce the dates. And I'm sure today's session was quite a learning experience. I think I've enjoyed every single minute of listening to both Hemant and Rakhi, in spite of being in the industry for 2 decades. I think it was a lot of learning, lot of insights. And so, all suggestions are welcome. I will now hand over to Rekha.
Thank you, Nehal. Thank you, Hemant, and thank you, Rakhi, for the, allowing us to spend well our time on a Sunday morning. I mean, almost 2 hours of a lot of knowledge, insight, and very interesting session on consumption, the products which we are like daily consuming. So I would say one mantra which has come out of the discussion is, as you consume, you go on investing on those products. So the products which you believe in strongly, which you have been using and which you see people investing in on a daily regular basis, are the ones which I think would be the right ones to invest and create a wealth for ourselves. So if you have any lasting note to add on to that.
Thanks. I mean, it was a wonderful session. A lot of interesting questions. We love, I mean, it's a very interactive session, and that's what makes it more lively. And Nehal and Rekha and the team, wonderful to get the kind of attendance that this webinar had. And looking forward to more. Thanks a lot.
Thank you so much. So we so much are looking forward to having another session with you as soon as possible we can manage. So thank you again, and you have a great day ahead. Thank you, everyone. Thank you all the attendees, and thank you all to my fellow colleagues and panelists. Have a great Sunday ahead. Thank you.
Thank you. Bye-bye.
Bye.